category of ratios we're going to look at now. These are called profitability ratios. And profitability ratios measure the performance of the company. Now, no matter what you do, no matter what kind of business you have, at the end of the day, what you want to do, of course, is generate income. And a common measure of income is net income. There's a lot of discussion about whether or not that's the best measure of income, but nonetheless, very common measure. And in most textbooks, that's the measure of income they use in these profitability ratios. So all these profitability ratios, you'll note, the numerator is net income. Now, a common measure of profitability is profit margin, return on sales, net income divided by sales. And indeed, if this turned out in your calculator to be 0.08, that's the decimal equivalent of 8%. That means for every dollar in sales, you're generating 8 cents in net income. You have an 8% profit margin. All things being equal, of course, you'd rather have this to be what? Higher as opposed to lower. Net income on total assets. If this turned out to be 0.12 or 12%, you would tell people that your return on assets is 12%. Return on total assets is also often referred to as return on investment, ROI. The logic there is, again, as a financial manager, you take all the equity and the debt, capital, and you invest it in assets that hopefully generate income. Return on investment, the assets on the balance sheet, that's the investments of the company. And indeed, just like the return on sales ratio, you like return on investments, return on total assets to be as high as possible. Return on fixed assets. Now, this turned out to be 0.14, excuse me. This turned out to be 0.14 or 14%. You would say that the firm has a fixed asset return of 14%. Your return on fixed assets is 14%. Now again, you should note the denominator here is not gross fixed assets, but net fixed assets. Net fixed assets is gross fixed assets minus accumulated depreciation, which we'll talk about a little later on down the road. But nonetheless, that's net fixed assets that you're looking for here. And like all the rest of them, the higher the number, the better. Probably the most widely watched financial ratio there is now is called return on equity, ROE. And it's net income divided by equity. And so we're talking about the profitability number now being this thing right here. And net income over equity, very widely watched. Companies will say, you know, you should invest your money, you owner, your potential owners out there, in our company. If you do, we earn a 19% return on equity. If the typical firm in the industry is generating 12%, they'll say, listen, you should want a 19% return on your investment rather than a 12% return on your equity. This is the owner's investment into the company. Now, what analysts will tell you, if you see a company whose return on equity is much higher than the industry average, what they'll tell you is you shouldn't think good, you should think debt. ROE is the most widely watched ratio there is. It's also the most widely manipulated ratio there is. And the way it's manipulated is, you know, companies will go out, they'll invest in fixed assets. Instead of financing some of it with equity, they finance it all with debt, which means the equity, the denominator, stays the same. And if that asset they bought with the debt generates revenue greater than the expenses, they're going to add more net income. And so you end up with a rising net income where equity stays the same, and you see a rise in ROE, return on equity. And again, that's analysts will tell you that, you know, ROEs that are much higher than everyone else's, usually is an indicator of greater debt. The price of greater return is always greater risk. And in this case, the price of this greater return is greater financial risk, greater bankruptcy risk, because the company's using more debt financing, less equity financing.